All right, so we are here with special guest Byron Spence with FBC. Byron, thank you so much for coming on.
Thanks for having me. Appreciate it.
So one of the things, obviously this time of year, realtor tax tips, as we said at the start, it's like pay your taxes or put money away for your taxes.
Right.
But there's certain things that you can take advantage of as a realtor that people need to be aware of.
Correct.
And Kirsten is the sketchiest tax.
I was about to say, I think the tax season is a very exciting time. It is. It's a very exciting time.
It can be. Just how you frame it.
Well, it is. Like, you never know. I feel like if you do a really good job of managing your money and finding out what you can take advantage of, this can end up being the type of thing where you're like, I have all this money that I don't have to give to the government. But you have to know all of these things in advance to be able to do it. So it can be exciting if you learn the things that you're going to teach us.
If you know the rules. So really the way, a lot of people don't realize is the rules are actually in favor of the taxpayer. You just have to know what they are. And a lot of people don't have time to sit down and read 3,000 pages of tax law. So so if you have somebody who's working with you to help you through that, it can be exciting. Look at all these, here's what I made this year and here's all these cool ways that I can offset that and pay the least amount of tax I can pay.
Oh,
so,
worth every penny to work with somebody to do that, because if you work with the right people, the money comes back.
I really have to give Kirsten a ton of credit, because Kirsten is that person who asks questions about everything and is always talking to our accountant. And we had this presentation in Red Deer that Byron did for our Red Deer group, and Kirsten sat there the entire time elbowing me about like stuff that we should be writing off. And so it was fantastic. I was a little sore by the end, but it's helped because we've put through more. We've even brought things up with our accountants, as well as
you had some great tips.
Awesome.
But I'm telling you guys, like check out FBC. We're going to talk about how you get involved at the end. But having people that know, just like you said, the advantages is so great. Great. So you have a presentation that you can take us through to give us some tax tips for realtors.
Absolutely, I do, yes. So what I'm going to do is I'm going to go through a few of the major tax tips, things that you might want to consider, things that a lot of people might be taking advantage of, but they could be doing a little bit more aggressively. So I will cover that. And at the end, we'll give you an opportunity, if you have questions, to get in touch with us. We'd be happy to answer them. So
perfect.
Yeah.
Great.
Cool. Well, let's roll.
Sounds good. Okay, perfect.
Yep. Good to
All
go.
right, perfect. So minimizing realtor tax pain, that's what I've entitled this presentation, so I'll do my best to accomplish that goal. Just a little bit about FBC real quick. We have been around for quite some time. We've been around over 66 years. We're the only Canadian firm with a year-round membership model. We're a tax technology leader at optimizing tax returns, so what that means is we were one of the first companies to actually file tax returns electronically. Believe it or not, yes. So our reps back in the day would go around with suitcase-sized computers and handle people's taxes.
Really?
Yeah, you bet. And we're also one of the only firms in Canada that works with you from the comfort of your own home. So we come to you, and it does not have to be during business hours. We come whenever works best, so it works really well for realtors. Nationwide, 300 highly trained, motivated staff for one goal, which is also incidentally our motto. Some people say it's cute, to make your life less taxing. So that's kind of what we try to do. Yeah, so that's us. So there's 517.7 million reasons why the next 15 minutes matter. So I'll show some stats that are specific to realtors. So 28,000, so they had a period of time where they took a look at how many audits, reassessments, et cetera, were done on realtors specifically. So between 2015 and 2017, they did 28,246 audits, reassessments, et cetera, on real estate professionals, which resulted in $517 million of additional revenue for the CRA.
Oh, boy.
So
this is lucrative for them.
Exactly, yeah. So $18,000 is what it worked out to per assessment on average. So here's the thing. When they're looking at, when the CRA is looking at who to pick on, essentially, right, they'll say, hey, who's our best return on investment? So my question would be, based on these numbers, do you think it might be in their best interest to continue to pick on realtors?
Yes.
Unfortunately, yes.
Wow.
Unfortunately, yes. So additionally, if false statements were made, or if they determine false statements were made, an additional penalty of up to 50% may apply. So it's significant. So those are the number side of things, but there's also the time investment side of things. So the average business spends over 60 hours just complying with CRA auditors. So if everything goes extremely well, it ends up with a zero balance. You don't owe anything. You don't get anything back. You've still, on average, spent 61 hours just dealing with them, which oftentimes will lead to up to 9.8 days of lost productivity.
Wow.
So where this is especially problematic, again, even if you have nothing to worry about, the audit turns out fine. If you lose 10 days of productivity in the spring market, as a realtor, might that have an impact on your business?
Huge.
Right?
Huge.
So what we like to do is first of all, you want to make sure you have somebody in your corner to deal with this, because it's the time and it weighs on you. I had a client we took on one time. He came to us and he told us that he'd been under various forms of audit for about 14 years. So at that point, he's distracted. I don't know if I'm going to have a house at the end of the year. I don't know if they're going to take, I don't know how this is going to work out. So it does weigh on you. So you want to make sure that
Don't live like that.
correct. Don't live like that. So that's the best way to do it. So just some of the best defense, just keep really good records. So, you're supposed to keep 6 years, but it's from the last notice of assessment, which is why you've probably heard 7 years. My recommendation to folks is just keep 10 years. Just
Nice.
keep 10 years of records. Beyond that, you're safe to have a bonfire, whatever you want to do to get rid of them. But 10 years would be the amount of records that I'd recommend keeping. You've got to keep them paper ledger, electronic bookkeeping software, so you do have to keep them added up in a format that's understandable. And you must keep original receipts or digital copies of the original receipts. So I'll make a distinction there. So if, for example, you take a client out to Earl's for lunch and you'll have the Visa slip or the itemized receipt, which one do you think that you need to keep for the CRA?
Well, I know the answer to this one because my accounting department has got us very much where it's like, you need to go back and get the itemized receipt.
The itemized receipt, absolutely. You need to be able to show what that expense was comprised of. So you can actually get rid of the Visa slip if you want to. I'd keep them both just in case. And you have to either keep the original copy or a scan of that original copy, but it does have to be the itemized version of it. So my recommendation, even if you're keeping digital copies, just keep the original somewhere, because if something goes wrong, computer crashes, you still have copies of that.
Yeah.
So here's some good news. As I mentioned earlier in the presentation, the laws are actually in your favor. There's over 3,000 pages of them. I like to give this example. If this was 100% of all the rules out there, 20% are black and white, so they're really not up to a whole lot of interpretation. But 80% can be interpreted in multiple ways. And what I mean by that is we've had this before. We've got two clients, exact same situation or very close. One person, both under audit, one person, the auditor saying, yep, this is fine, no problem here. The other person, the auditor, saying, nope, this is not acceptable. Now remember, they're both subject to the same laws, it's just two different auditors are interpreting it in different ways. So really, the vast majority of tax laws out there are open to interpretation, so you want to make sure you have somebody who knows what they're doing, making justifications on your behalf or dealing with an auditor on your behalf. So let's go through a few tax tips for real estate professionals. So number one, I love this one, meals and entertainment, because it's oftentimes underutilized by people in the real estate industry. So real estate professionals, well, here's the cool thing. So if you take somebody out to lunch, what's a question that you could ask to make that into a business meeting fairly easily? I'll ask you guys.
I guess you could say something like, how's your house?
Yeah. Are you looking to buy or sell anything at the moment?
Yeah. Do you know anybody that might be looking to buy or sell? Or?
Exactly. So you ask this question, and that's now officially a business meeting, right? They could say no, absolutely. No, I don't. That's okay. You can't win them all, right?
Yeah.
So, but you've discussed business, and now you can legitimately write that off as a business expense. So the other thing that you are supposed to keep here when you are writing off meals and entertainment is you're actually supposed to keep a tax journal to keep a log of who you met with, when, and what was discussed. So when I'm working with live audiences, I'll ask, in the room, how many people have a tax journal? Usually 2 out of 100 put their hands up. So I'm expecting it to be probably a similar ratio on this in this segment, but. One of the ways you can achieve the same objective far easier is you can just flip over that receipt and write the name of who you met with and just briefly what was discussed. And it could just be as simple as talked about the market or discussed listing property next year. Whatever that is, you have met the criteria of Canada Revenue Agency when it comes to keeping records for the purposes of meals and entertainment.
I just got to add to that for a second, because I now the pen in my console of my car. When I get out and I sit in my car, when I get in, I start my car and I quickly write on the back of the receipt, and then it goes in the breast jacket pocket or the console, whatever, and then when I walk into the house, I bring that receipt with me. But if you just do it right there and then,
right away,
it is absolutely the easiest thing.
Yep, and then it's done. You don't have to think about it later. You don't have to be, who was I meeting with? What did we talk about? It's done. It's handled.
3 years later.
Exactly, yes. When you're under audit, oh no, what was that about? Another thing to be aware of when it comes to meals and entertainment, it is subject to something called the 50% rule. And either you know what that applies to when it comes to meal, why they have 50%. You're only allowed to claim 50% of the full expense.
Yeah, but it has something to do with yourself.
Correct. So essentially the CRA is saying if you take a client out to lunch, you had to eat anyway. So you chose to go to Earl's and have lunch with your client, but they're saying, well, you could have gone home and had a sandwich. So they'll allow you to expense the client portion of the meal, but your portion isn't expensible. So you don't have to really keep track of it. You just take the full expense at the end of the year, and 50% of that will be eligible to be claimed.
Right. So, and unfortunately, even if you met with 4 people, it's still 50%.
Correct.
Even though it's
yes.
like 50%. But I only had 20%.
Yeah, you could technically play with that. I would recommend you just leave it at 50%. Rather than going for the exceptions, just 50% is the easiest way to do it. So another one would be business use of home. So the nice thing about being a real estate professional is that you can write off a home office because you are doing work there. So there's a few of the things that you can do: utilities, property taxes, house insurance, repairs, mortgage interest. And I'll be specific about this, the interest portion, not the principal, but the interest you can expense. And you take the business use portion of all these expenses. So the rule is they take the square footage of your entire space and the square footage that is used for business. So let's say you've got 1,000 square feet of living space, 200 square feet is your business use. Then you would take 20% of all these associated expenses. So 20% of your house insurance, 20% of property tax, et cetera, et cetera. So a lot of people are underutilizing their claim on home office.
Yeah, especially repairs. Like some people oh, I had a furnace guy out.
Yeah.
Well, that would also be
absolutely
20%.
Oh, good one.
Yeah. So you get a new roof, you get a new furnace. Like these are things that are important for. They also impact the business portion of the home, right?
we just got a new roof last year. So Kirsten, you guys can't see her, but she's like, I get the darts. It's like, did you do the new roof? And it's like, yes, Kirsten, I did the new
got
roof.
That. So yeah, absolutely. Anything that has to do with the house, you can claim that portion of it. So
Nice.
So another one would be tracking your mileage. So similar to your tax journal for meals and entertainment, you are technically supposed to keep a logbook. So what I'd recommend doing, most people are not keeping a logbook or are not keeping a detailed enough logbook.
Yeah.
The great thing is most people nowadays have smartphones. So they have in their pocket already the ability to have a logbook that's more detailed and more accurate than they could ever hope to keep pen and paper. So this is just one example of a mile catcher. It has nothing to do with FBC. There's plenty of them out there, but really what they'll do, good ones will actually sense when you're driving. You don't even have to tell it you've started the trip. It'll sense that you're probably not running 50 kilometers an hour.
Yes.
So it'll say, okay, here was the beginning of the trip, here's the end of the trip, and at the end it will buzz and just say, hey, was that a business trip or a personal trip? And you'll just let it know. Well, that was a business trip, and it'll automatically keep track of all your mileage for you and keep a running total of your vehicle expenses for the year.
And that was called Mile Catcher.
Mile Catcher is that app
Catcher.
specifically, but there are others as well. Mile IQ. Just take a look in the App Store, and there's plenty of options there. Another one would be donation promotional expenses. So believe it or not, just because something isn't necessarily a charitable receipt will be issued in that case, doesn't mean you can't expense it. So for example, if you sponsor a hockey team or your kid's soccer team and you get some sort of advantage for it, they put your name on the jersey or you're behind the backstop, CIR is back there. As long as you can prove that the business had a potential benefit from it. So you can then claim it as a promotional expense. So in this case here, I've got an example of a baseball team that was sponsored by a real estate company. So as long as you can show, and if you get audited, you just want to keep proof of it. So whether it be a picture of the jersey, a copy of the leaflet that was handed out, something that you could show the auditor to say, hey, this is what I got for my money, and it helped the business. So if that's the case, you can then expense it as a promotional expense, which is frankly better because you can expense it 100% instead of a percentage of it. So
we were at an event last weekend, or on Saturday, one of our realtors put on, and I had this conversation based off of reminded me of it, your recommendation, and I said, and she was showing me the amount of charitable money she's given, and I said, well, hold on a second here, how much, you're on this sponsorship thing here, you're here. I'm like, write all of this off, call it marketing versus the charity thing, because people think, oh great, I get to write this off because it's charity. It's like, well, marketing is a better write-off. Most people don't know that.
Correct.
People think that charities are 100% write-off, and that's not necessarily the case.
Correct. Mm-hmm. Yeah.
So,
no, it's better if it's promotional. Actually.
It is. Yeah.
So, excellent. So another one you can do. Lindsay alluded to this earlier today. Making mortgage interest tax deductible. So if you have some equity in your home, let's say you have $300,000 in equity in your home, and you take out a second mortgage, and you use the proceeds of said mortgage to invest in something. It doesn't have to be property, but great opportunity now. So if you were to invest in a few different rental properties or investment properties with that equity, you can then write off the interest of that mortgage.
Beautiful.
So beautiful opportunity to invest in a market while it's down, get a few more properties in your portfolio, and in the meantime, but here's the caveat, it does 100% have to be for investment purposes. You can't go buy a new car and an investment property. It has to be 100% directed at an investment of some sort. So,
Yeah.
But great
or
opportunity.
the percentage of those proceeds. So you take out a line of credit and you don't take a vacation on a line of credit. But anyways, let's hypothetically.
bad idea. Yeah, that's right.
You take out $100,000, you spend 90 on a property and 10 on personal stuff, renovations on your current house or things like that. Then that $90,000 that you did spend in the investment, you would get to write off that portion.
Correct. Yeah. So you would, to the best of your ability, you want to keep it as clean as possible, so that if it comes into question, you can show exactly what interest
fair.
applied to which portion.
Nice.
Kind of
Yep.
So another one that tends to be problematic with real estate professionals, keeping business and personal accounts separate. So a really easy way to do this, I always recommend, is just to get yourself a credit card that you use only for business-related transactions. So a couple things there. Number one, you want to make sure that it is a points-bearing card, because as it stands right now with CRA, points are not a taxable benefit. So if you go to Jamaica on money we're going to spend anyway with the business, you're not going to be taxable on that. Now, if you use a points-bearing card, there's typically an annual fee associated with it. Now, if every transaction on that card was business-related, you can actually expense that annual fee. The other thing, too, is, and again, everything has to be business on there, if you carry a balance from one month to the next and you are assessed interest, you can then expense the interest as long as it was all business-related. And the biggest benefit is, when you're doing your records or your accountant's doing your records, all those transactions are business-related. So you're not having to go through there with a highlighter and take out Safeway and anything else that may not be business-related. So it's a really easy way to keep things clean. I like to give this visual. If you were to imagine that all these annoying little receipts that you have to look after throughout the year have a dollar value to you at the end of the year.
So true.
It becomes a little bit more encouraging to look after them. So in this case, we have a $50 Staples receipt that's going to equal a $20 tax savings to this client at the end of the year.
And I just want to make a statement. There's lots of realtors that are so busy. They're running around. And they got this receipt, and now they got to run off to the next appointment. You guys are literally, or you're literally killing yourself in terms of your future benefit. It's like you're just delaying this inevitable, or where you don't save this receipt. You're going to get assessed taxed on it later. And this receipt can be money back in your pocket. Yeah. And that money is just, those receipts are real and tangible. The kilometers are real and tangible. And I love this visual because it identifies it. And if you just think of receipts as $20 bills, there's no way you're going to take a $20 bill and just kind of stash it or throw it away or get lost in an inbox somewhere or in between the seats in your car. Like, this is absolutely imperative. Or even when you're at lunch and the receipt gets left and someone says, do you want your receipt? Some realtors are just so busy they say, I'll deal with this later because it's more important to focus on this deal.
Yeah.
This is going to bite you.
Yeah.
This is part of general business acumen. I mean,
Right.
This is so important.
Yeah. And on that note, so just as a best practice, every 3 months or so, you want to go through that center console, dig them out from under your seat, out of the glove box, and just put them in. You can go to Walmart and pick these things up for $5, $6, an accordion folder, and just keep them organized. So if you do that as you go every 3 months or so, then you're not going to get to the end of the year with a big daunting task of adding up everything.
And if you keep a good calendar and you haven't been as disciplined with writing on the back, then you can look back at your calendar, know who you met with. You'll be able to remember 3 months ago versus 3 years ago.
Correct.
And your calendar can be a fossil record to help you get those receipts up to date.
Yeah, absolutely. No, that's a good point as well. So just in wrapping this up quickly, I'll just tell you a little bit about how FBC operates with our clients. We have our 4 pillars of service that we offer: planning, preparation, consultation, and protection. So one of the very first things we do with our clients is we'll do a 3 to 5 year tax history review, take a look at what's been done, make sure it's been good. And then we'll sit down with the client and go over the good and bad of what's happened over that past 3 to 5 years and put together a tax plan with them. So here's the good and the bad of what's happened up till now. What can we do from today forward to make sure we get you where you want to go in the most tax efficient way possible. Preparation, as I mentioned, is on site. We work with you at a time that works best. Consultation with us is unlimited. You don't have to worry about picking up the phone and worrying if this question is worth $50 to ask. It is unlimited with us, in-house or over the phone. And last but not least, protection. If you get audited as a client of FBC, Your responsibility is to let us know the name and number of the auditor, and we'll handle it from there. So we do all the back and forth with them. If they want to come and meet you in person, we'll also physically be there so you don't say something and get yourself in trouble.
And that's
That's
that 60
incredible.
hours. Like that's that
incredible.
time that we're talking about.
Yes, so that's one of those things that even if you have nothing to worry about, just the time investment to have someone doing that for you allows you to focus on your business. So that's why we offer that.
I've seen people get audited, and just to add this, audited, and it's like, hey, great, so the auditor says I'm going to come to your house. And they show up, and you got all your stuff at the kitchen table, and there's no home office, and the auditor's looking around being like, you have 20% written off of your home office. Like, what's happening here?
Yeah.
So the advice that a professional can advise, like yourselves on this, is just invaluable.
Absolutely. It's good not to try to do the, I mean, I actually got audited a couple years ago, and even though I'm in the industry, I still had somebody else from my company represent me because it's just too close to home. You want to have somebody kind of keeping that insulation between you and the auditor.
Yeah.
So even if you know the rules, it's good to have that intermediary. So one of the things we'd like to offer, we appreciate the opportunity to give us your time this morning. So we'd like to offer you a second opinion on your taxes. If anything that we've covered this morning has triggered something where you say, well, why haven't I had that discussion with my accountant at any point, or that seems interesting, we're offering a free consultation. What that'll look like, we'll sit down, we'll go through some questions with you to see where your situation is right now. If we think that we can help, we'll let you know and go into what it is that we do. And if we think you're in good shape, we'll let you know that too. There's enough bad accountants out there. We do not need to take from what's working, so we're happy to tell you when you're in good hands. But if there's something we can do for you, we'd be happy to do it. Go over what pricing looks like, and either it makes sense for you or it doesn't. So we'll give you some information here. So Katie McDougall will be the person to get in touch with. Here's her information here, so you can take that down. Get in touch with us. Also, I know we've covered a few things this morning, and sometimes people will have questions that are triggered by what we're covering. We'll be happy to answer them for you. So whether or not you want an appointment, give us a call. If you've got a specific question, we'd be happy to answer it for you.
Jordan, you nailed it. I was going to say, that's fbc.ca, right? And took off the logo there, so you guys can see the information there.
And then also on the 16th, you guys are coming back to do a full class in
Correct.
our PDC.
On the 18th.
On the 18th, yes, right, Thursday the 18th.
Yeah.
So if you want to sign up for that, this was very, very quick, but you have a lot of detail. There's a lot of questions that realtors have, and you have a full presentation that goes into a lot more than what you just talked about today.
Correct.
And it's also a great chance to meet Brian and Katie, ask some questions as well. So come out to that if you are interested, and that is on the calendar of events.
I feel like this is like something Ryan McKay would stand up and say, which is always a bit dangerous as soon as you. But Ryan McKay, one of our lawyers, but I feel like this is the equivalent to the January 1st of the fitness world, where the New Year's resolution, because you are all sitting here saying, this year will be different. This is the year I'll get into shape.
Yeah.
And this time of the year is when you're looking at your taxes and you're like, oh gosh, this year will be different. Well, the only way for this year to be different is if you take action, do something to change things up, and
Yep.
connecting with FBC is a great, great first step. And I like you said, a second opinion.
Yeah.
But I'll tell you, this time of the year, for most of you, it's going to be a first opinion for the taxes, and we're catching this early. So get a hold of Brian, get a hold of sort of Katie on there with that information. This section is going to be posted up online. Come out on the 18th. If it's a full house, we're going to stream it. So if you're in a market where you can't come out to our session, just send off an email. We'll make sure that it's streamed out so everyone gets to get the information. Absolutely imperative. Brian, thank you for your time.
Thanks so much for having me. Appreciate
Yeah.
it. And thank you for your time. Thanks for paying attention and on what sometimes isn't always the most exciting subject. So hopefully we've made it a fun 15, 20 minutes for you. So
Awesome. All right,
Thank you.
thank you.
We're going to be right back talking about some of the features we love in the new KV Core.